Alternative credit at Ares is where we do a lot of asset investing, where we focus on asset portfolios that generate cash flows. We're looking for contractual cash flows and assets that are resilient to stress. Much of what we do is lending. We lend against these asset portfolios.
If you just say, what do we do in alternative credit? It's really simple. Everything you're used to looking at from a corporate standpoint is really EBITDA focused, whether it be public equity, private equity, or direct lending. Everything we do is asset focused. And it's not just assets. Every single investment we make across everything we do is structured around an underlying portfolio. And that portfolio gives you huge diversity. But it's not just portfolio, it's a portfolio of contractual cash flows.
Much of our activity involves lending or financing portfolios of assets. So for example, we finance portfolios of auto loans, credit card receivables, small business loans, and residential mortgages. Not only do these assets form the collateral for our loans, but they also serve to generate the yield that we return to our investors. We also invest in asset portfolios directly, owning them outright. So for example, during the pandemic, we acquired a portfolio of about 170,000 shipping containers. We also acquired a portfolio of about 15,000 residential homes throughout the United States. As these assets are leased or rented, they generate the yield that we return to our investors. Some of the most interesting opportunities in alternative credit often come when there's been growth in an industry and a need for capital and scale. Thus, we've been increasingly active financing alternative energy assets and infrastructure.
So that ability to have a true relative value lens, that ability to rotate across asset classes, that ability to bring size and scale to the table with flexible capital, it really is one of our biggest advantages. Often buckets of capital where people want to invest just in one thing, those kind of buckets are the pathway to beta. Our alpha is the ability to bring size and scale to the capital with a large team, with a large pool at scale capital, and bring that to the best relative value that we're seeing across alternative credit.
We have been asset investors for a very long time and have navigated all kinds of market conditions, including some of the most accommodative and some of the most challenging. Along the way, we've learned lessons that inform what we are looking for in an investment. Just as importantly, we've also learned what to avoid and why.
We've collected over time our favorite lessons learned. We like to say our motto is Kaizen investing with purpose. There's the real importance in credit is not your wins, it's your losses. And anybody who's been doing this for a long time, you take losses, right? There are things that go wrong. The key isn't not taking losses. The key is learning from those losses.
One of our top lessons learned is that investing at its core is pattern recognition. We're asked sometimes by investors, well, how do you invest competently across so many different types of assets? Well, I think there are two answers to that question. One is we have a very large, very experienced team. In fact, we have more than 30 investment professionals on our team that have invested this way since the 1990s and have invested broadly across these markets. That is a big advantage.
We've learned that investments generating front-loaded cash flows derived from large, granular pools of assets tend to be highly resilient to stress, resulting in more predictable performance.
That is a pattern that we look for in our investments.
Having that mantra, having those lessons learned really goes to building and continuing to improve our credit DNA. That credit DNA really leads to how low our historical losses have been over time, because it speaks to making sure that you are learning from mistakes, you are continuously improving, but then also you're making sure that you stick to your mantras, your process, your profile, in everything we do.
Having been investors across many different asset classes over the years has also allowed us to accumulate a tremendous amount of data.
In fact, we begin every investment committee with the assumption that bad things happen the day after we make our investment. A default cycle starts, or a recession begins, or the financial health of a counterparty fails. We think that is the best evidence of how this all comes together for our investors.